Today we're talking about deposits, and you'll notice our little pun, deposits shaken to the core, is the name of our session today. The pun being core deposits are more valuable than ever in this changing environment. Deposits are top of mind for banks globally as regulations and looming rising rates will change deposit economics and have already fundamentally changed deposit economics. So today we're going to cover three key things in our short time together. The factors changing deposits and why traditional deposit management strategies will not work in the new environment. Okay, so what should you be doing or thinking about differently in managing deposits? And then the third thing, we'll review Treasury strategies capabilities to help you enhance the value of your deposit portfolio. So to start us off, Jim Poteet is going to share the factors that are changing and shaping deposits.
Thanks, Crystal. And to her point, you know, a lot has changed environmentally, right, all around us in the last several years. And certainly the regulatory and compliance impacts have been significant and probably are more top of mind versus any of the other factors. But, you know, you can rewind the calendar pretty much back to the repeal of Reg Q, which started sort of the regulatory environmental change. But obviously, I think, you know, Basel III is certainly more imminent for all of us and probably has the most impact as it relates to what's happening regulatory-wise around deposits. You know, it has forced a significant distinction between retail and commercial deposits and operating versus non-operating deposits, core versus non-core, right, that Crystal said, and instituted liquidity coverage ratios, which is also new. And so the way in which we look at deposits has to fundamentally change. Rates have been near zero for quite some time, and I think it's only natural that the focus has waned a little bit, to be fair, as we've all been focused on other more pressing business issues and more pressing issues around deposits. And so essentially, in large part, our portfolios have been left untouched. But considering the eventual and prediction of rising rates, probably starting as early as early part of next year, there's going to be a lot more emphasis, forced or just necessitated based on the interest rate changes. And so the models that we used to have back when interest rates were higher are going to have to be dusted off because there's more factors that have to go into the models than perhaps were there historically. They're going to have to be updated, but the question is, you know, how do you update it given all the continued uncertainty? You know, if you look north to Canada, arguably their banks survived considerably better than the U.S. banks did over the last several years with the economy and so forth. But, you know, they aren't immune to what's going on either, as they're interconnected with the global economy. The OSFI has issued their own mandates relative to capital adequacy requirements, and they've updated their liquidity principles, and so their new world looks dramatically different than it used to as well. We look across to Europe and Asia-Pacific, again, more cross-border implications, more emphasis on risk-rated assets and stress testing, and the linkages back to the U.S. banks. And so you look at regulations, you look at rates, you look at the focus and where it's been versus where it needs to be. You look at rather schizophrenic or unpredictable behaviors in the market, both from a commercial client standpoint and their habits and what they do with cash, as well as what the banks are doing. And the models, what we end up with is a real conundrum around what deposits look like today versus what they looked like before and how dynamic and what it's going to take to be successful going forward. And so, Crystal, to your point just a few minutes ago, I don't think all the strategies and tactics that we used to use are going to do us a whole lot of good going forward. So what do we do now?
Exactly, and thanks for teeing that up, Jim. You know, I think that the rising rate environment is really going to be the biggest game changer because the sustained low interest rates have really compressed or muted the impacts of regulation to date. And while we things like Basel and LCR requirements unto themselves will fundamentally change the economics of deposits. The rising rate environment is going to bring back things like, the impact of the repeal of Reg Q, and will clients now demand interest on certain deposits? And the changes in the money fund industry may impact corporates' short-term cash management, and in a rising rate environment, when historically you'd see more corporates take on an active short-term portfolio management or approach. Does the change in the money fund industry impact their choices and how they might manage cash as rates go up and they start to look more for a return, and they have more confidence in the economy and start to more actively manage their cash? So some of the traditional things that we've done as banks that will not work in the new environment are, as Jim, you mentioned, our internal models, the models that we use for balance sheet forecasting and deposit pricing. Many banks had deployed the same modeling techniques for retail and commercial deposits. We've been talking about the need to differentiate those for a while, but things like Basel have really codified the difference in expected behaviors between commercial and consumer clients. The sort of approach to quote-unquote selling deposits, that deposits will just kind of happen as we sell transaction banking services, and it sort of comes with certain services that we provide. That will no longer be the case, as not all deposits are as profitable or as desirable as others. So having a much more deliberate approach to deposits will be required in the new environment. Sales and relationship team compensation. Historically, many of the sales and relationship teams within banks were not compensated by or didn't have goals around deposits, or they may have had goals where deposits were all sort of given the same value in their incentive and compensation plan, and that will no longer be the case going forward as banks start to really codify and stratify the types of deposits they really want to bring onto the balance sheet. Traditional FTP methodology and deposit pricing. So historically, banks had applied, a partial they had done some analysis on their deposit behaviors to really identify what was core and what was volatile, and we had a blended short-term, long-term rate that made up our FTP methodology. Well, going forward, we fundamentally have to break down some of those long-standing models and calculations to incorporate the changing economics that things like LCR and the value of operational versus non-operational, FI deposits versus corporate will have. And so FTP methodologies of some banks are 10 and 20 years old, and they've just sort of been ingrained into the processes, and those will need to change. The lack of rate governance. We've seen a lot of banks take a more passive approach to deposit pricing, except when they get into highly competitive situations, and then there hasn't been as much discipline around things like exception pricing and really using high rates to win pieces of business. Well, going forward, those kinds of strategies will need to be modified to take into consideration the kind of deposit, the stability of that deposit, the overall operational relationship tied to that deposit. So the lack of rate governance and the use of high rates to compete will fundamentally need to change. And then finally, siloed management. I know, Jim, you're going to talk about this a little bit in the next section, but the lack of coordination between corporate treasury, the ALM group, and the lines of business can no longer really work in the new environment. And we've seen that as banks have gone through their regulatory planning, testing, especially as it relates to Basel and LCR requirements, we've seen a great improvement in this area, but there's still a lot, I think, of siloed decisions and management processes that will need to be more coordinated going forward. So we just talk through some things that we can't continue to do in the new environment. So what should we be doing differently? And Jim is going to talk through 4 key things to consider or change in your go-forward deposit strategy.
Yeah, thanks, Crystal. I mean, from an industry perspective, we've touched on a little bit. We've sort of been in our own rhythm for quite some time in regards to how we deal with deposits, and we know now that there are too many disruptors out there that are going to cause us to have to reevaluate and construct new rhythms going forward. And to some extent, we are still learning what that is going to mean. But certainly there are a couple of key areas that you've got to spend some time understanding what the implications are for your organization, not the least of which is your competition and how they're going to respond. You know, one thing that makes this really quite interesting is the fact that competitively, in most of the traditional treasury management products, we all sort of pretty much know what our competitors are able to do and offer as it relates to a specific treasury offering, lockbox services or ACH or cash vault. But from a deposit standpoint, because our portfolios are so different bank to bank and the requirements are going to be so different bank to bank in regards to what they have to do to manage LCR, you know, are we going to have as much confidence around what our neighbor is going to be doing and how they're going to respond? And so how we think about client acquisition, and to Crystal's point, maybe the great client yesterday was not going to be your great client going forward. But client acquisition strategies, pricing, certainly that's going to be very different today than it was historically. You know, what are your actual deposit product offerings and how are you going to position those in the marketplace? And then the front-end client messaging. So we're going to talk about your core clients today and the conversations you might have to have with them tomorrow, but what about new clients? What's going to be your messaging out into the market at that point? You know, the linkages, you know, between the strategy development and the tactical implementation, we see varying degrees of maturity and pace with our bank clients as it relates to the strategy development they have around the changing environment for deposits, and have they translated that into the tactical implementation steps they have to execute. You know, the compliance requirements and the data that's going to be required for reporting purposes. Do you have it systemically available to you? Is your infrastructure designed that way, or are you already capturing information that you know you have to report on? Or if not, you know, what's your plan to be able to do that? And then the linkage between, you know, the treasury management business and commercial lending is likely going to have to continue to be ever more tight going forward than it may have been historically. You know, organizationally, we see who owns deposits, selling and managing as somewhat of an organizational hot potato. Again, we see this maturing at different paces. Deposits touches so many groups between the corporate treasury, the individual line of business, whichever one that is that might own the P&L, what the treasury management officers are doing, the RMs are doing, and ultimately where will it end up, and how do you plan to account for the refresh of goals and objectives and performance metrics depending upon where ultimately the responsibility does lie. And then sales and client discussions, again, you know, we used to love deposits bringing to us, but maybe not so much anymore. And the profitability hit is going to be there. There's no way to be immune to the hit. It's about what do you do to manage yourself and your portfolios through it. Those short-term valuations are going to have an impact. How does that relate to the overall relationship profitability? Are your best clients still your best clients? And what are your plans to fill that profitability gap? It may be obvious, it may not be, but there's going to have to be, I think, a broadening of how an individual client's worth to the organization is viewed and managed, such that the deposit piece is going to probably become a more important portion of how that client's worth within the organization gets assessed. Now, Crystal, I think you're going to walk us through now what Treasury Strategies' approach is going to be to helping our clients strategically assess their deposit strategies and come out the other side with very transformational and positive results.
Great. Thank you, Jim. So we've had a long history of helping banks develop powerful deposit strategies, and not just sort of pie-in-the-sky theoretical exercises, but real strategies and tactical plans to execute on those strategies. we have, over the last 3 or 4 years, been strong advocates around changing regulation for the financial services industries and for your clients. We've been engaged by the Chamber of Commerce to really represent the impact to corporate treasury of some of the more recent regulations related to Dodd Frank and the Volcker Rule. We've done a lot of work around money market reform and really helping the regulators understand the true primary and secondary impacts of those regulations. And it's really critical to have that kind of understanding of not just the regulation and its direct impacts, but how do these all come together? How is this really shaping the value of our deposits, the go-forward strategy? Because, you could look at each regulation, rising interest rates, changing confidence in the economy and economic recovery. You can look at those independently, but really bringing them together is the most critical part in understanding the interrelation between all of those. We also work directly with corporate treasury groups and helping companies plan for the impacts of these regulations, rising rates, managing their liquidity and their short-term portfolios. And we bring that perspective to you, that direct work with the corporate and how they're thinking about their cash flows and how they're thinking about their liquidity and working capital management in these changing times. Our deposit work goes back many years when Reg Q was first on the drawing table, around 2000, 2002, and we've continued to work with our clients on really understanding their deposit portfolios, the impact of regulation, the need to really change deposit models, and modeling the differences in behaviors between commercial and consumer deposits, and how that impacts balance sheet and funds transfer pricing, because that internal alignment is really critical. And as I mentioned earlier, it's going to be even more important going forward. And then finally, the translation to a business strategy. So it's really great to understand and do a lot of analysis and modeling and everything, but what does that mean when you actually go into the market and you need to talk to clients about the changing value of their deposits and how you can help them better manage liquidity and sort of the give-take relationship, when historically in this business, we were so hungry for deposits, we kind of took all deposits and thought they were great in many cases. And so having to about face in many cases with certain clients is really tough to execute, and having a real strong message and internal plan to manage your relationship and sales teams and how you interact with the market is critical. And so we really help our clients through the entire life cycle of interpreting the environment. So what are the regulations you need to be thinking about, both direct and secondary? How are customer behaviors changing and expect to change going forward? What will the impact of rising rates be in the changing economic environment? And then really diagnosing your current state. Okay, so we understand what's happening in the environment, what will happen, but what do we have today? What's driving our deposit behaviors today? How volatile are our deposits? What kinds of products, services, or relationship components are driving deposit levels and stability? How do our sales processes, goals, and incentives really align with what we want to achieve with deposits? Do we have the right pricing models and pricing governance structure in place? And then, do we have the right deposit and liquidity solutions, and are we positioning them well in the market to meet the changing needs of the environment and our clients? Evaluating the options, identifying and testing new pricing and management structures, reviewing new products and liquidity solution, assessing your deposit segmentation frameworks and your associated sales and positioning strategies, and really modeling and estimating the financial impacts. Developing the strategy and roadmap and really getting tactical, deploying that strategy, training for your sales and relationships teams. What are the conversations they need to be having with clients? How do they explain the changing economics of deposits for banks? Developing wallet sizing and prospects lists for you. How much deposits should you have from your clients? What's your target there? And what are some ways that you can really become the concentration bank and really increase your wallet share of deposits? And then, really helping to design new products and or sales goals and incentives, things like that. The real nitty-gritty of, okay, so we've got this great strategy, how do we get that into the market and really start to shape our deposit book? So these 20 minutes go by pretty quickly, but hopefully we've raised some evocative thoughts, some things you need to be thinking about as we manage deposits in this changing environment. please feel free to call Jim or myself. We're happy to chat more with you about what we're seeing in the market, ways we can help shape your strategy. And if you do have some questions, please, you can go ahead and submit them through the Q&A. We'll leave that open for a few minutes, and we'll get back to you after the session. We'll send you a written response. If you want us to call you, we're happy to do that as well. So thank you for joining for our first coffee breaks session. We'll have one in a few weeks, next month, and we'll continue this on a monthly basis and hopefully get you thinking about the hot topics in transaction banking, liquidity, and treasury. Thanks so much for joining us today, everyone.